What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. If sounds like something you're interested in, consider subscribing, as I do also provide technical analysis on Sundays. And I do provide a daily pulse on the market at Hemi137 on X as well. So check me out there. But before we get started, remember to hit the like button, drop some comments on what you're looking at. What is your strategy for the week? Some tickers you're looking at, and let's go ahead and look over the past week on what we can expect. So, like I always do, we like to dive into the recap. There's been a lot going on at this point. What we're kind of doing is starting to establish a new thesis. I try to reevaluate our thesis until an event occurs. A lot of major events have occurred over the past couple months and now, so we are shifting weight on what matters at this point. What matters at this point are two things. One, we need to watch inflation, and the second one being is we need to know what is going on with this recession that we're currently going through, despite everybody saying, or the previous talking heads saying that it never existed, that we were essentially in a strong and resilient state. So now we are trying to prove that that is incorrect, where you have a new Secretary of Treasury that is telling you the private sector has been in a recession for a long period of time. And we are starting to see that looking back and reflecting, there were no jobs that all these jobs that have been reported are all ghost jobs. People are losing jobs and there is no other jobs to go to. So people are holding on to the current jobs that they have. Not only that, we're finding out more and more details about more manipulation that is occurring. But before we get too heavily into that, let's talk about the non-farm payroll. The non-farm payroll came in at 151K versus 159K expected. Now, again, with Doge and the currently massive cutting that's occurring in the government, which again is making up a solid chunk of the GDP, which the Fed did come out this past week. They did start out saying that we were negative 1.5 GDP is what they were anticipating this coming week. I think we do get GDP numbers coming up this week, but then they revised it down even lower to negative 2.5 as what is currently going on with essentially the massive layoffs that's occurring with the federal government in Doge right now. So that will be extremely important to watch, as I do believe that is essentially Trump is going to force the Fed's hand to cut. He asked them to cut. He said there's no need or desire to, because the way the market is, it's strong and resilient, like we've heard multiple times, despite everything being said. Reports coming out saying that is not the case. People working two full-time jobs and you tell them that thing is strong and resilient, they're not going to believe you. And then only to find out that a lot of these taxpayers have been paying for all these programs and everything else. That's essentially quantitative easing for everybody else but the taxpayer is essentially what you've been living in. So you have been living in stagflation if you're a native uh, American at this point. So with that being said, again, we had the jobs report that came out. Again, the market didn't really know how to interpret that. Again, the market is really seeing. Uh, I think we have a window. I think we have a window between this month and next several months. We're going to start really seeing what's going to occur or what has occurred from the Doge and them essentially removing a lot of the fraud and waste from the government. Again, that takes time for that to be removed and those jobs to really reflect. Again, because of the massive amount of manipulation, it's hard to get true numbers on things. This is why the Fed, again, is very reactionary of the fact because of what's the fraud and manipulation that's been occurring. So, but again, we're going to have to keep eyes on this moving forward, at least until the market says we're in a recession and we price in a recession. Now we have started diving down. We have started correcting essentially almost since the beginning of the year. We had a very weak bullish push into what was supposed to be one of the biggest quarters of 2024. Again, people don't have money. This is shown by buy now, pay later numbers, by delinquencies on credit cards, by charge rates skyrocketing. You have a lot of major issues that people just don't have money. Essentially, that the average the age of home ownership is now at 55. It was just not only a couple months ago, it was at 35. So the age ranges from 35 and 45 have essentially been selling and moving in with their adult parents, which again is the biggest working class out there. And they are essentially depleting all of their assets, trying to keep them afloat as they are working two full-time jobs to fund uh, aid packages to Ukraine, or if that is even illegal immigrants, and why you're seeing massive uptick in coffee and orange juice and massive amounts of inflation and demand, that people are scratching their head like, where is this demand coming from? Because we obviously are not doing that. We are skipping meals. We are doing everything we can just to keep a roof over our head and to keep food in our mouths. So again, non-farm payrolls, I think, are going to be extremely important until we get that to correction. However, that may unfold, whether it's going to be through the report or maybe it's going to be some headline news, we don't know. But there are a lot of things that are being uncovered, especially with this administration. It wouldn't be surprising if you wake up in the morning and some news article came out that started correcting market even more. Although I do believe we are starting to correct, despite them saying that we wouldn't have any cuts this year, or now starting to price in 3 cuts this year starting in June. So we'll have to see how that plays out. The Doge has saved $177 billion from what the clock says. As it continues to grow, we'll see how that is reflected. Again, they've talked about a Doge dividend. I don't think that's very smart at this point. People need cash. I understand that, but we also have a massive amount of debt, and that essentially on March here, in another week, that debt ceiling is another big event we have this week going on too. We're coming to the debt ceiling that has to be agreed upon. That has to be fixed, because again, we're not going to be able to cover our cost. And I know they've been talking about the Treasury having to step in as well. This is where essentially the Treasury would step in. If we can't pay our bills, then the Treasury would essentially create $1 trillion coin and pay off all our debt, which is wild to think, but they have the power to do that. So, but with that being said, this is some of the information that I've been talking about. The Wall Street Journal just came out this week, and they've talked about FHA has essentially been bailing out subprime loans. So people that are having like low 500 credit scores have been granted these loans for homes, and then they come 90 days and they can't afford the home. And what is happening is then they fall into this COVID rule to where they reduce the price of the monthly expense, and then they are now starting to pay it. This has been going on like 2 or 3 years ago. So this has been going on well under the Biden administration. And apparently there's 400 backlog foreclosures. So no, you are not going crazy. What has been happening is your own taxpayer dollars have been paying and bailing out people who can't pay their mortgage. And so this is why you're getting sky high prices for houses and sky high rents, because people just can't afford to move. You're getting this massive bloat in these numbers, and it's something that the Doge is going to be looking at hopefully here soon. But there was about over 500,000 payments on delinquent payments. I have payments on it twice on delinquencies. Payments on delinquencies. So essentially, that's what's been going on over the past 2 year and a half. So the 2022, you were not delusional to think that that was the most anticipated recession that was supposed to happen that did not happen. This is why you cannot bet against the Fed. You cannot bet against the government, because the way, again, they will provide quantitative easing to those who feel they need it. So essentially, they are living off the backs of taxpayers, leveraging, having essentially no um, consultation for the people that they are taking this money from. They think it's free money, but it's not, because people are working 2 to 3 full-time jobs and paying all these taxes for these people to be so wasteful and leveraging these positions that when they mess up, they're like, oh, my bad. And then they just get bailed out anyway. And that's what you're seeing. And now you're seeing it in the private sector, where you're seeing with FHA and these subprime loans that they give out that they shouldn't be giving out, are now saying, oh, well, we'll just bail you out. You're okay, just stay where you're at. And then they can continue to pay a reduced price in these homes while everybody else is struggling to find a place to stay or working 3 jobs or working their butt off, and they can't pay rent or they can't pay their home for their family or whatever the case is because other people are locked in because your taxpayers have gone to bailing them out. And that's what's been going on. I've been talking about this for over probably a year and a half, maybe 2 years, is that they just stopped plain reporting uh, delinquent veteran loans is something I've brought up multiple times. And so, again, they continue to block the information. They continue to bail people out that shouldn't be bailed out. And then there's no accountability, which is causing major, major issues. And we just keep wildly spending and continuing to place that burden on the taxpayer. So, whether you choose to or not, you are going to have to work twice, 3 times as hard to pay for these things that you did not opt into. So, with that being said, we do have Trump signing executive order to establish a strategic Bitcoin reserve. He said he would not use taxpayer dollars to buy more reserves, but nonetheless, they're going to essentially be more strategic about what they currently have. They're not just going to sell Bitcoin. Kind of thing is what they talked about, which was a huge disappointment for the crypto side of the house. I thought it'd be a lot of influx of money, which I do believe there will be an influx of money, but it won't be for Bitcoin. I think Bitcoin is going to be Bitcoin, and they're just not going to sell it. And then all these other coins, these layer one coins, perhaps altcoins, whatever the case is, those are going to be bought up with taxpayer money. That's going to build a reserve. I think they already announced that some of the others the other L1s like ETH and Cardano, and essentially, I can't recall the other one for some reason off the top of my head. It's completely drawn a blank, but they have announced in Sol and a couple other ones as well. XRP is the other one. That's the one I was thinking of. So they announced those as being part of the reserves. So I think the taxpayer money will go to those coins, but they won't add any more to Bitcoin. They will just hold Bitcoin. So we'll see if that is true or not. But that's kind of the feel and the look that we've got this past week. So big information that's currently going on, more wasteful and fraud continuing to come out, which is it's gut-wrenching to see a lot of this stuff. But again, we'll continue to watch and see what happens. But this next week, we got some big information. We got the debt ceiling, which is obviously going on. And then we do have a core CPI that comes out on Wednesday. Again, there's going to be a lot more weight on there because if for some reason what we're anticipating for us to get a major correction in the market, what you're going to need is either really high inflation, or what you're going to need is inflation that is rapidly decreasing. And then you also have unemployment, which is sky high. And we just had the unemployment numbers, and they don't look as bad as 151, which is compared to some of the job numbers we had not that long ago is quite wild. But and understand that even the new jobs being created I think it was only like 17,000 this week. So there's hardly any new jobs being created. So it's just a really tight bind to where we're currently at. So inflation, there's going to be a lot more inflation weight placed on inflation because of that fact. Because if inflation does start to rise, that is going to be huge. But again, I don't think it will because of the fact we're not also spending $185 billion on illegal immigration, housing, and food. And we're not pumping a lot of that money back in, artificially doing that. So at this point, it's going to be a lot more raw data as the months continue. And so I think we'll start seeing more of a deflationary state. Although if we do see people are concerned that because of tariffs, it might be very inflationary, which could be a huge problem. But again, it's more of a short-term issue than it really is a long-term. It's better off in the long run. But again, we have to wait and see how that plays out. So we have to be patient with a lot of these things to work into the system and how they play out. That's again why I do the micro, not the macro. The macro takes a longer time to play out than the micro does. But it's good to know where we are headed. And so it's good to kind of have a thesis to that macro, but ultimately, again, more focused heavily more on the micro. So we'll have that on Wednesday. So that will be a huge report. And why that is such a huge report, because they're pricing in the end of the world, and more so than I've probably seen in a very, very long time. We do also have core PPI. Won't hold as much weight as the core CPI. But again, you're also dealing with the debt ceilings. You have the debt ceiling and the core CPI, which are two big events that are going on this week. And that's what you need to be focused on. Monetary policy isn't until next week. Again, that will heavily depend. The jobs report is making everything look fine and dandy. What's really going to matter is, and going to add to that decision is going to be what comes from this core report. So when the core CPI comes out, that will have a heavily influence on monetary policy as well. Now, if we start to see massive deflation, and if you go off of any of the revisions of the job numbers, we're in a massive problem here with employment, and so we need one to kind of act to reflect that. And right now, we're not really seeing that because, again, the headline news is showing we got a strong labor market, and we have no inflation, which is essentially the Fed is like, well, there's no need for us to do anything, but there's just nothing going on there. When in fact, if you're looking at the revisions and everything else, think the job market's been horribly bad, and inflation has been coming down to an extent. But I think, again, now that you're cutting out a lot of that waste, it's going to be a lot more accurate when it comes to your inflation reports and your unemployment reports. But again, that will take time to play out. So again, big week on deck. We have core, like I said. Earnings will continue to go on for the rest of the month. We don't really care about earnings. There's going to always be some good earnings out there that are going on. But again, ultimately, we are waiting for the next earnings cycle, which will start in only a month. We'll start getting industry leaders again. So we need to see how bad this next week and 2 weeks will be. If the market sustains itself in the next 2 weeks, I'm expecting the market to rally again. The market's designed to go up. Unless we get some major bad news that occurs in the next 2 weeks, which I'm not totally anticipating things bad. We have start slightly corrected. Again, you have to understand you're coming into a normal part of the year where you typically pull back anyway. So that really shouldn't be anything new there. So with all that being said, really looking for, again, if something big's going to happen, it has to happen within the next 2 weeks, or else the market's just going to continue to go back up. And it could be a great buying opportunity right now, but again, we'll have to see. Now, the expected moves, again, like I said, the market is pricing in 152 points. And if you follow me at all, that is wildly outside of the norm. That's almost double what the norm is. Normally, the average expected move is maybe about 65, and that's even inflated just because of the current environment that we've been in over the past couple of years. But now it's even double that from what it is this week. And again, because two big things going on, you have this debt ceiling, and you essentially have, again, the core inflation report, which are going to be very big. Tesla's pricing in 23 points. Anytime you talk about inflation, tech is always going to be the representative of that. Whatever happens, if inflation is high, tech's going to sell off. If inflation is low, tech's going to skyrocket up. BA is priced in a little bit more than normal. It's priced in about another point, which again, BA doesn't move that much. When the price is in a point, it's a lot. JP Morgan is pricing in 9, which is a lot because they typically only float around that 5. So they're pricing in a lot this week. So we are really anticipating a big event to occur this week. And so they don't want you to, and why we look at these expected moves is because we want to stay away from options when they price in too much, because all that's going to happen is you're going to buy option. It doesn't matter how much it moves. You got way too much to try to account for that move to actually start being profitable on that option. So this is why you just don't trade them during these kinds of weeks, because there's just too much going on. Now, individual stocks, maybe you get a better chance, but on the index, there's no way. Like it could drop 152 points and you would not get a single dime. You would actually be burning cash, which is wild to think, but that's how the options are working on the theta and the delta that are currently priced in this week. So you really have to keep that in mind. So, but with all that being said, that is pretty much what I got. Again, remember to drop a like, comment down below, and I will see you guys on the next one.